Welcome to the deep dive. Thinking about the stock market, it often feels like trying to figure out what's really going on in a noisy room.
Yeah, distinguishing the real conviction from just background chatter, especially for newcomers.
Exactly. Is that big buy order genuine strength or just, professional maneuvering? It's tough.
It really is.
hmm
Understanding that difference between real direction and maybe just temporary activity is key.
And that is precisely what we're diving into today. We're looking at a specific tool designed to help see through some of that noise.
Right, something to gauge the underlying buying or selling pressure.
It's called the Chaikin Money Flow Indicator, or CMF for short.
And our roadmap for this is actually a really helpful YouTube video from Trading with Grow. They give a good practical look at it.
Okay, so our mission for this deep dive, let's unpack how the CMF works, why it's considered significant, and maybe how you could use it to judge those market forces better.
Yeah, potentially leading to more informed trading decisions.
Yeah.
So where do we start? The calculation.
Let's get into the guts of it.
Yeah.
What actually feeds the CMF indicator? What's under the hood?
Well, what's interesting, and the video points this out right away, is that it's not just price. Volume is a critical component here.
Volume. Okay, that makes sense. Like how many people are backing the move with actual trades.
Exactly.
Yeah.
High volume can suggest stronger belief behind a price change. CMF integrates that directly.
Right. Price alone can sometimes be deceptive. Big volume adds weight.
It really does. Now, one crucial point from the source, you can't just slap the CMF onto, say, the Nifty or Bank Nifty spot charts.
Oh, why not?
Because those spot index charts usually don't have reliable, consolidated volume data.
Okay, that's a really important distinction. So individual stocks are fine.
Individual stocks, yes, or futures contracts for the indices like Nifty futures. Those have volume.
Got it. So good for stock traders. What does the CMF actually look like on the chart? What does it tell you?
It's an oscillator. Think of it like a gauge that swings back and forth.
An oscillator, okay. Like RSI or MANSI in principle.
Similar in that it fluctuates, yeah. Specifically, the CMF moves between +1 and -1.
+1 and -1. Those are the absolute extremes.
And they are. And the basic idea is pretty straightforward. Positive values suggest buying pressure is dominant.
So potentially bullish?
Potentially, yes. And conversely, negative values suggest selling pressure is taking hold.
Leaning bearish. Okay. Simple enough at first glance.
But there's more nuance. The video also mentioned it can sometimes give early warnings, like potential exit signals within a trend.
Ooh, early exits. That sounds useful. How does that work?
Where imagine you're in a winning trade. If the CMF starts to weaken, say, it was strongly positive but starts dropping even if the price is still okay.
It might mean the underlying buying fuel is running low.
Exactly. It could be a heads up that the trend's momentum is fading, maybe prompting you to lock in some profits before a potential reversal.
That ability to maybe get out before things turn sharply sounds really valuable. Okay, so we have the +1 extremes, but the video mentioned those are rare.
Very rare in practice. More theoretical limits.
So what are the more practical levels traders should watch?
The video really zooms in on +0.05, -0.05, and -0.05. Those are presented as the more significant threshold.
0.05, positive and negative. Okay. Not zero, but slightly off zero.
Right. The thinking presented is that a CMF closing above +0.05 suggests more sustained buying interest.
Potentially a zone to look for buy signals?
That's the idea. And conversely, a close below -0.05 could indicate more persistent selling pressure.
Maybe time to consider sells or be cautious if you're long. Why 0.05 specifically? Is there a reason for that number?
It acts as a buffer, essentially. It helps filter out minor, insignificant jiggles around the zero line that might not mean much, helps avoid whipsaws.
Okay, so trying to catch more meaningful shifts in pressure, not just noise.
Precisely. The video also touched on the range between like +0.5 and -0.5 being very extreme.
Halfway to the maximums.
Yeah, and typically unsustainable. The market rarely maintains that kind of intense one-sided pressure for long.
Good to know. Okay, so we have the basics. Oscillator volume matters, key levels are ±0.05. The video used Tata Steel as an example.
It did. A practical walkthrough.
How does someone actually, put this on their chart if they're using a typical platform?
Usually pretty easy. You'd go to your indicator list, search for Chaikin Money Flow, and add it.
Standard procedure. Any specific settings?
The video used the default, which is often a 20-period look back. That's quite common.
Okay. And they tweak the appearance a bit, something about the axis and lines.
Yeah, they did two things. They changed the axis color, the zero line basically, to white.
To make it less prominent.
Seems like it.
Yeah.
But more importantly, they added horizontal lines directly at +0.05 and now you can see 0.05.
Ah, highlighting those key thresholds we just talked about.
Exactly. It visually shifts your focus from just crossing zero to crossing these potentially more significant buffer levels. Helps avoid getting faked out by minor zero crosses.
Makes sense. Visual clarity is huge when you're watching charts live. Okay, so walk us through what they showed on that Tata Steel chart with these levels.
They pointed out a few instances, for example, after a gap up in price.
A strong opening move.
Right. Then they showed the CMF subsequently closing above that plus 0.05 line.
Okay.
And in those cases, the price tended to continue moving upwards afterwards.
So the CMF crossing acted like a confirmation of that initial bullish strength.
That's how it's presented, yeah. Adding a layer of confidence, maybe.
Interesting. And did it work for exits, too?
They show that as well. Situations where, after a nice run-up, the CMF then closed back below the plus 0.05 line.
Ah, suggesting the buying pressure was easing off.
Potentially, yes. And the suggestion was that could be a signal to consider taking profits or exiting the trade near the highs.
So entry confirmation and potential exit signals. What about the downside? Did they show bearish examples?
Yes, definitely. There was an instance where the CMF moved below minus 0.05.
The negative threshold.
Right. And following that signal, the video showed the stock price starting a downtrend.
Okay, a potential sell signal playing out.
And they even mentioned a specific use case for options traders there,
Oh, yeah.
suggesting that seeing the CMF drop below 0.05 near a swing high might be a good time to consider selling call options, betting against further upside.
A specific strategy link. That's useful context. Let's circle back to why these plus minus 0.05 levels are used. You mentioned filtering noise.
Yeah, that's the core idea. Trading purely on zero crossovers can generate a lot of false signals. Little blips above or below zero happen all the time.
And can get you stopped out unnecessarily.
Exactly. That 0.05 buffer aims to ensure there's a bit more substance, a more sustained push behind the move before you consider acting on it.
Looking for stronger agreement between price and volume, basically.
Pretty much. And related to that, the video stressed again that you rarely see those really high CMF values, like 0.4 or 0.5.
Right, the extremes are rare. What's the takeaway there? Don't wait for perfection.
Essentially, yes. You don't need the CMF to hit the roof to see a major price move.
Got an example?
They mentioned that even during a significant Tata Steel rally, maybe 50% or so,
Wow, okay.
the CMF only peaked around 0.3 to 0.35, not even close to the theoretical max.
That really drives the point home.
Yeah.
The strong trend doesn't require an extreme CMF reading. Good expectation management.
Definitely.
Now, what about those sideways markets? The choppy, range-bound stuff that drives traders crazy? Can CMF help there?
It can, indirectly, because the indicator's looking for sustained pressure above plus 0.05 or below netted 0.05.
In a sideways market, you probably don't get that sustained pressure.
Often, no.
Right.
The CMF might just wiggle around zero, staying mostly within that plus and a 0.05 band.
So the lack of a clear signal is the signal.
In a way, yes, it can signal, hey, there's no dominant force right now, maybe stay out. It helps avoid trading when there's no real edge.
Okay, that's valuable too, knowing when not to trade. Now, the video really emphasized combining CMF with price action.
Oh, absolutely critical. No indicator's a magic bullet.
You need context.
You always need context. Price action trends, support, resistance, patterns gives you that context. CMF can then act as a confirmation tool.
So, see something on the price chart, then check if CMF agrees.
That's a great way to put it. It increases the probability that what you're seeing in price is backed by genuine volume flow. It's about building conviction.
Can you give a concrete example of that synergy?
Sure. Breakouts are a classic one mentioned in the video. Price breaks above a key resistance level.
A potential buy signal.
Right. But is it real? If, at the same time, the CMF also moves positively and closes above plus 0.05.
It adds confidence that buyers are genuinely stepping in with volume.
Exactly.
Yeah.
It strengthens the case for that breakout being legitimate, makes the potential trade look more robust.
Gotcha. Confirmation. What about using it for managing trades, like trailing stops?
Yeah, that was another interesting application discussed. Let's say you're long, and the CMF is nicely above plus 0.05.
Riding the trend.
You could potentially use that plus 0.05 level as your line in the sand. Stay in the trade as long as CMF closes above it.
And if it closes back below,
That could be your signal that buying pressure is fading. Maybe time to tighten the stop loss or even exit and lock in the profit.
Like that Tata Steel example, exiting around 111, 112 after the run-up.
That seemed to be the idea illustrated, yes.
Yeah.
Using the CMF drop as the trigger.
So it helps define when the conditions supporting your trade might be ending. What about overall market structure, like higher highs and lows?
Good point. You absolutely need to consider the underlying price trend.
How does that interact with CMF signals?
Well, if you're in a clear uptrend, price making higher highs and higher lows, you might give less weight to a brief dip in the CMF below zero, or even below negative 0.05.
Because the main trend is still up.
Right. The primary trend context is strong. You might wait for the price action itself to break down, like making a lower high and lower low, before really acting on a negative CMF signal.
So price structure acts as a filter for the CMF signals in a way.
A very important filter, yes. Context is king.
The video also mentioned something about the CMF itself sometimes moving in a range, even if the stock is in a broader range.
Yeah, that was subtle but interesting. Like, CMF might oscillate between, say, zero point 0.2 and 0.4 while the stock chops around.
So the CMF has its own mini range within the indicator panel.
Kind of, and the suggestion was if the CMF hits the top of its own typical range, like 0.4 in that example, and starts turning down.
Even if it's still above plus 0.05.
Right. It might be a signal that, within the current conditions, the buying pressure is peaking. Maybe a good spot to consider taking partial profits.
Yeah, like banking some gains because the indicator suggests a local top in momentum, even if the bigger trend hasn't broken.
Exactly. A more nuanced risk management tactic.
Okay, so lots of ways to potentially use it. The presenter wrapped up by stressing practice.
Crucial, as with any tool. You need screen time.
Why is that hands-on experience so vital here?
Because you start to get a feel for how the CMF behaves on different stocks, in different market types, trending, ranging. You see its strengths, its weaknesses.
You learn its personality, so to speak.
Exactly. Backtesting, observing it live alongside price action. That's how you really learn to interpret its signals effectively and build confidence in using it. Theory is one thing. Practice makes it usable.
Couldn't agree more. Real-world application is where the learning solidifies. Okay, let's try and summarize then. What are the key takeaways from this deep dive into CMF based on the Trading with Grow video?
I'd say, 1, CMF is a useful oscillator linking price and, crucially, volume.
Giving insight into buying-selling pressure?
Right. 2, use it on stocks or futures, not spot indices usually.
Because of volume data.
Yes. 3, the plus-minus 0.05 levels are often more practical thresholds than 0 or the extremes of +1.1.
Helps filter noise, potentially identifies more sustained moves.
4, don't expect extreme CMF readings even in strong trends. Moderate readings are common.
And it can help identify sideways chop when it stays within that plus-minus 0.05 band.
Definitely. And maybe most importantly, 5,
Yeah.
always use it with price action analysis.
As confirmation for exits, for context, not in isolation.
Never in isolation. Combining them increases your odds.
So really, incorporating something like CMF adds that volume dimension, giving you a potentially richer view of what's driving the price.
Precisely. It gets you thinking about the conviction, the force behind the bars on the chart, not just the bars themselves.
Okay, a final thought then for you, our listener, to mull over. How might paying attention to volume-based indicators, like this Chaikin Money Flow, change how you perceive price movements? Does knowing about the underlying flow of money shift your perspective on simple supply and demand? Something to think about.
Definitely food for thought.
Thanks for joining us for this deep dive.